For this particular fund that you're raising for now, given the time in the US cycle that we're at, what do you think is the outlook for this particular fund in terms of its next 5, 7 years, in terms of where pricing sits now and what you expect to happen?
Sure. So, just to give a quick overview of what's happened generally in the real estate market over the last few years. Um, when COVID hit, the US government pumped $5 trillion of stimulus into the US economy. And so that completely ramped up the real estate market. So we came out of COVID, and in 2021, we saw 0% interest rates, $5 trillion of stimulus, and a lot of pent up demand. And what happened was we had more transaction volume in real estate than we've ever had in our history. So 2021 was absolute peak volume and peak pricing for real estate. On a cap rate basis, on the multifamily side, you were seeing 3-4% cap rates, which is extremely low by historical standards. And again, it was driven by the fact that there was a lot of rent growth and people were able to buy real estate with very, very cheap, high leverage debt. Okay. Now, as interest rates have adjusted over the last 18 months, we've effectively gone from a 0% federal funds rate to a 5% federal funds rate. That has had a dramatic impact on pricing and transaction volume for real estate. So in 2013, we are seeing values down between 20 and 30%, depending on asset class, from where they were trading in 2021. We're also seeing a complete halt of transaction volume. So overall transaction volume is down about 70 to 75% this year from what we have seen in the last few years. And because there was so much floating rate, high leverage debt originated in 2021, debt maturities are going to almost double from this year to next year. So what's happening is values are down 20 to 30%. No one's transacting because they don't want to sell for 25% less than what they thought their asset was worth 2 years ago. But because of the debt maturity wave hitting in 2024 and 25, there's going to be a capitulation, and it's going to force a lot of owners to make a decision. They have to either refinance, or they have to sell, or they have to do something else to recapitalize their asset. What we're seeing is that the larger institutional owners have the dry powder and the capital that they need to hold on to their real estate and work through the next few years of higher borrowing costs. Those middle market, primarily the syndicator network, they don't have the ability to write checks and be as patient. And because the debt markets are so much tighter today than they were 2 or 3 years ago, it's going to force a lot of groups to sell at a discount from where they traded in the last 2 years. So for us, we're really excited about that basis reset. I think a really important nuance, though, is product type. So multifamily and industrial have been the strongest overall property types in the US over the last several years. And when you look at their long-term fundamentals, they still remain very healthy and very strong. The affordability of renting versus owning in the United States has never been lower. So we're seeing a consumer base that is renting for longer because it's unaffordable to buy a home. And we're also seeing new construction starts drop off a cliff as the ability to get accretive construction financing is extremely difficult. So we have increasing demand and we have waning supply over the next 5 years. So we're really excited about the long-term growth fundamentals of multifamily. Similarly, on the industrial side, that new supply picture, new starts are also falling dramatically because of the economics of debt financing. And On the demand side, we've gone from 10 to 15% e-commerce adoption as a total of as a percentage of total retail sales in the US during COVID. So we went from 10 to 15. That was a 50% increase in the amount of e-commerce goods traded, which drives distribution industrial product. That's still way behind a lot of other developed countries. For example, China, I believe, is close to 30% of e-commerce sales as a percentage of the total. So there's still tremendous growth there. And there's also a huge movement for onshoring and manufacturing in the US. So whether it's the large chip plants that you may have heard about in or EV facilities, onshoring, there's a tremendous movement to bring a lot of the manufacturing that's been offshored into the US. And there's trillions of dollars of investment happening there. So that's going to create hundreds and hundreds of millions of square feet of demand in the industrial space. And so as a result, we're seeing strong occupancy and sustained rental growth in those two product types. So just to bring it all together, we plan on buying assets at a discount well below replacement cost and trading at a discount to where they were worth 2 years ago, but with strong long-term fundamentals and a healthy trajectory to continue to grow in value and NOI.